Now, we got to turn to your money and Wall Street, where stocks are roaring back this morning after 2 days of stomach-turning plunges, more than 1,300 points on the Dow. Here's where we are right now, a little over half an hour into the trading day, and boom, Dow Jones Industrial Average up almost 330 this morning. We've already heard from Treasury Secretary Steve Mnuchin. He spoke to CNBC, and he downplayed the recent market turmoil.
I think the fundamentals are still very strong. The U.S. economy is strong. U.S. earnings are strong. So I see this as just a natural correction after the markets were up a lot.
I would agree with that. Most professional investors would, too. The person who hasn't is the president. Let's bring in CNBC contributor Ron Insana. And with me for the hour, Republican strategist, my friend Noel Nikpour, and host of Slate's daily podcast, The Gist, Mike Pesca. Mr. Insana, let's start with you. We just heard from Steve Mnuchin, and he said a pretty reasonable thing. No, it's not the Fed. This is normal market moves. What do you think?
Well, it could solve that. I mean, it could be the Fed and it could be a normal market move if the stock market is responding to what has been an ongoing series of interest rate increases from the Fed as it attempts to normalize interest rate policy in a post-crisis world. So oftentimes you expect the market to have, at least on occasion, a negative reaction to the prospects of rising interest rates. Short rates and long rates have jumped pretty sharply in the last week. They've moderated in the last couple of days. And so that does put downward pressure on stocks, along with a host of other considerations, Stephanie, like the ongoing trade war with China, worries about a global economic slowdown, and even some potential weakness in housing and auto sales here have all been identified as reasons for the pretty sharp pullback we've seen in the last couple of days.
But, Ron, shouldn't we acknowledge that one of the reasons the Fed looks to raise interest rates, especially when the economy is doing so well, is because they need to create a cushion. Because if things do turn and we face a recession, they need to have some sort of lever to help us. And with rates extraordinarily low, they won't have that. And one of the things that could cause such a recession would be the deficit ballooning. And it has ballooned at the hand of the current president of the United States.
Yeah, one could argue that the reason the economy is so strong is that the president, with the tax cut and with the rather large 2-year budget that was passed, has borrowed from future growth and pulled some of it forward, which is why the economy has accelerated lately, which is why then the Federal Reserve has to raise interest rates to keep inflation from going too far above its 2% target. So you have, in a certain sense, monetary and fiscal policy right now working at cross purposes. And should there be a recession in the next year or two, you're not going to get another tax cut. You're not going to get more spending. The only thing you have is the Federal Reserve lowering rates again. And so, yes, in addition to building a cushion, the Fed's also responding to the fact that the economy is strong enough, at least in the short run, to withstand these interest rate increases, which it should be doing if indeed the economy is accelerating at this point. We're out of the crisis mode, long out of it, in fact, and so it's appropriate for the Fed to behave the way they are.
All right, Ron, Chicago Federal Reserve President Charles Evans, he spoke with your colleague and my friend Steve Liesman this morning, and he was specifically asked about the president's comments, saying that the Fed has gone wild, a bit loco. Here's what he said.
We're looking at the economy. We're looking at a very strong economy, strong fundamentals, and we're adjusting the policy stance. We've been doing that gradually, increasing rates. We've been moving up. We're targeting 2 to 2.25% right now. I kind of think neutral is in the 2 3/4 to 3%. So after many, many years of accommodative policy, which I have supported strongly because inflation is now up at 2%, it's time to readjust the policy stance, at least to neutral. Let's see how the economy is performing at that point, and then we might have to do a little bit more after that.
Ron, what do you make of that?
Well, I think that's a perfect explanation. You know, the president and others said that the Fed was crazy to bring interest rates down to zero in the post-crisis environment and keep them there for so long, creating a bubble in the stock market. Now the president's complaining that the Fed's raising rates and also touting a very strong economy at the same time. So there's a lot of cognitive dissonance there. This is exactly what the Fed should be doing at this juncture. They managed to keep us from going into a Great Depression very deftly, and now they're very gently handling the normalization of interest rates. And so I think the Fed could go too far. They could precipitate a bear market in stocks. They could help to precipitate a recession. But right now, that's not what they're doing. And they're really just trying to get rates back to normal, around 3% for short-term rates. And again, they will have some cushion should the economy slow down. But this is an environment where interest rates should be normal. And the people who complained about the first round of unconventional policies after the crisis were wrong. And they're wrong again with respect to what the Fed's doing now.
Hey there, I'm Chris Hayes from MSNBC. Thanks for watching MSNBC on YouTube. If you want to keep keep up to date with the videos we're putting out, you can click subscribe just below me or click over on this list to see lots of other great videos.